Day trading can be an exciting way to participate in the stock market, but it's crucial to understand the potential pitfalls that come with it. In this video, we will walk you through the risks of day trading, helping you make informed decisions about your investment journey in 8 steps. Step 1. Understand volatility and market risk. Day trading is a high-stakes endeavor characterized by the frequent buying and selling of financial instruments within the confines of a single trading day. While it offers the allure of quick profits, it also brings with it a substantial degree of market risk and volatility. To illustrate this, consider a scenario where an individual initiates a stock purchase early in the trading day, with the optimistic expectation that its value will ascend. Due to the unstable nature of the financial markets, unexpected occurrences or quick news releases may quickly cause a rapid and unplanned decrease in the price of that stock. These unfavorable events might result in major financial losses for the day trader as the trading day goes on. This example underscores the inherent dangers of day trading, where market conditions can shift rapidly and unpredictably, making it imperative for participants to exercise caution. Step 2. Manage your emotional stress. Engaging in day trading, a high-stakes financial endeavor, frequently demands rapid decision-making under intense time constraints, and this constant pressure can undoubtedly generate substantial emotional stress for traders. Consider the constant alertness necessary to keep tabs on the unstable and volatile financial markets, where even a little slip in concentration can result in huge profits or losses. Deep worry and emotional tiredness can emerge from the need to make split-second decisions in the face of shifting stock prices and economic news. Traders often find themselves navigating a roller coaster of emotions, from the euphoria of a successful trade to the despair of a sudden downturn. This emotional turbulence can take a toll on mental well-being, potentially impacting not only one's financial performance, but also their overall quality of life. Step 3. Consider the implications of high transaction costs. Frequent trading in financial markets can lead to the accrual of significant transaction costs, including various fees and commissions. For instance, if a person makes a lot of trades in one day, even seemingly insignificant costs connected with each trade can quickly erode prospective gains, making it more difficult to achieve a net gain. These transaction costs can take on a number of different shapes, such as brokerage commissions, exchange fees, and regulatory fees, all of which are deducted from the total returns produced by trading operations. Therefore, the impact of these costs increases with trading frequency, possibly making it more difficult to realize a good return on investment. Therefore, it is imperative for traders and investors to carefully consider the implications of high transaction costs when developing their strategies, and to strike a balance between trading frequency and the potential profitability of their investments. Step 4. Diversify our funds. Day traders frequently encounter a significant challenge in the form of a lack of diversification, which arises when they concentrate their investments on only a handful of securities. This limited scope of investment exposes them to heightened risks. For instance, if a day trader decides to allocate their entire capital into just a few individual stocks, and if these selected stocks happen to underperform or experience a sudden decline in value, their entire portfolio becomes exceptionally vulnerable. In such a scenario, the trader's financial well-being becomes intricately tied to the fate of those select stocks, leaving them without the protective cushion that diversification can offer. The absence of diversification increases the potential for substantial losses, as it leaves the trader highly exposed to the individual fluctuations and vulnerabilities of those few securities, emphasizing the importance of a diversified investment strategy to mitigate risk and achieve more stable and sustainable returns. Step 5. Don't overtrade. Overtrading represents a prevalent and perilous risk within the realm of day trading, a financial practice characterized by the rapid buying and selling of assets within the same trading day. Overtrading can stem from various psychological factors, such as the desire for quick profits, the fear of missing out on potential opportunities, or an addiction to the adrenaline rush associated with trading. To mitigate this risk, day traders should establish clear trading plans, adhere to predetermined entry and exit points, and exercise discipline and restraint in their trading activities, rather than succumbing to the allure of excessive trading volume driven by emotion rather than strategy. Step 6. Invest time in educating yourself. Entering into day trading without a well-researched and comprehensive strategy can significantly increase the likelihood of poor financial outcomes. If you embark on day trading without a solid grasp of both technical and fundamental analysis, you may find yourself in a precarious position. Technical analysis involves studying price charts and patterns to predict future price movements, while fundamental analysis delves into the financial health and performance of the companies you're trading. Without a firm understanding of these analytical tools, you may struggle to identify lucrative trading opportunities or adequately assess the risks associated with your trades. This lack of knowledge can lead to hasty and ill-informed decisions, resulting in losses rather than gains. Therefore, it's crucial for aspiring day traders to invest time in educating themselves and developing a robust trading strategy before venturing into the volatile world of day trading. Step 7. Address the importance of risk management. Neglecting the implementation of effective risk management strategies in any financial endeavor can pave the way for potentially devastating consequences. Consider a scenario where you disregard the use of critical risk management tools like stop-loss orders or position sizing rules. In such a situation, you might find yourself clinging on to underperforming investments, fueled by the hope that they will bounce back to profitability. However, this unwarranted optimism can spiral into a downward financial spiral, as these losing positions continue to drain your resources and capital. The absence of stop-loss orders means you have no predefined exit points to limit your losses, while the absence of position sizing rules leaves you vulnerable to allocating too much capital to a single investment, amplifying potential losses even further. In the absence of robust risk management, these mounting losses can rapidly erode your portfolio, undermining your financial stability and objectives. Therefore, it is imperative to acknowledge and address the importance of risk management in order to safeguard your investments and financial well-being. Step 8. Recognize and manage the potential stress in personal life. Day traders often find themselves immersed in the fast-paced world of financial markets, constantly monitoring stock charts and executing trades. This constant attention to the screen can lead to strained relationships, as loved ones may feel neglected or frustrated by the trader's inability to fully engage in quality time together. Moreover, the unpredictable nature of day trading can create a sense of instability in personal finances, adding further stress to relationships. Consequently, while day trading can be financially rewarding, it is essential for individuals to recognize and manage the potential strain it can place on their personal lives, ensuring they strike a healthier balance between their trading ambitions and their relationships. By staying informed and cautious, you can make informed decisions and navigate the world of day trading more safely. That's all in this session. See you in the next video.